Hey, accounting scholars, welcome back to Chapter 9, Section 3. Hey, we're going to work on a little problem here that the IKEA Furniture Company has. Uh, you know, this would be a pretty typical problem or event that would occur in a manufacturing company like IKEA. And IKEA is a manufacturing company as well as a merchandising company because they actually sell stuff at the stores here in fact around the world, in addition to Chicagoland area. But let's say IKEA Furniture Company had the following beginning balances. They had direct materials of 10,000, they had work in process of 5,200, and they had 16,500. So during this time, they purchased 17,500 of direct materials, and they issued 19,000 of direct materials in production. So that's pretty much going to impact the direct materials account. And then in the work in process area, the company used 5,700 of direct labor and applied 7,000 in manufacturing overhead to production. And again, manufacturing overhead here are all those indirect costs that aren't necessarily associated with a particular product. The cost of utilities in a factory, again, the vice president or director of manufacturing salary, that type of thing. And then, these last events, the cost of goods manufactured for the period was 26.9, while the cost of goods sold was 28.4. Those would typically be involved in the finished goods inventory account. So let's see how we might record these in a direct materials inventory T account. As we stated, there was $10,000 in the direct materials inventory at the beginning of the period. Then we added 17,000 in direct material, 17,500 in direct materials purchased, and then we issued $19,000 of direct material into production. So that was the $19,000 credit. So our balance of the direct materials inventory at the end of the period is essentially $8,500. So we'd have a similar kind of activity going on with the work in process inventory. Here again, we started out, as stated in the problem, with $5,200 in work in process inventory. And then the company had 5,700 in direct labor. They also applied 7,000 in terms of manufacturing overhead, and they actually then transferred out 26,900 to the finished goods inventory account. That left approximately 10,000 in the work in process inventory. So we've talked about direct materials and raw materials. Now let's talk about the finished goods inventory. And the finished goods inventory is pretty straightforward here as well. The beginning balance was 16,500. We had 26,900 transferred in to finished goods inventory. The finished goods transferred out, cost of goods sold, which is a term you're very familiar with, is 28,400, and the net balance is $15,000. So it's a pretty straightforward process. The math isn't too difficult here. It's just a matter of finding the right bucket to put it in the general ledger. So kind of keep that in your mind when you think about manufacturing inventories. It disaggregates itself basically into three categories: that raw material part or direct material part, the work in process or WIP, or the finished goods inventory. Okay, let's talk about how does the manufacturing overhead application process work. Okay, so now we're going to start getting into some more complicated areas, but again, if you understand the logic of it at a high level, it's pretty much direct application of some basic math to make this determination. So here's the problem again. When you have direct materials associated with a product, it's very easy to associate the cost of that product to those materials. However, when you have other costs that aren't necessarily directly related to that particular product, you have a category called overhead, meaning that the factory itself, the depreciation of the factory itself, the utility costs, the costs of management, which aren't related to a particular product line, those are all overhead costs. So the process here would be as follows. First you would estimate the overhead from the beginning of the period, and you would basically associated with estimating the overhead at the beginning of the period is looking at the unit related costs. Those could be things that vary with the number of units produced. You would look at the batch related costs, which would relate to which would vary with the number of batches produced. You would estimate the product sustaining costs, which could vary with the number of product lines, and you would also estimate the facility sustaining costs, which are essentially fixed costs, right? So you would need to do that in order to estimate the manufacturing overhead for each of these cost-related pools: unit-related costs, batch-related costs, product-sustaining costs, and facilities costs. So once you do that, then you are going to estimate the cost driver for each of those cost pools. So essentially what you're going to try and do is come up with a number, which in this case is called a cost driver, which relates to each of these. How does a unit related or batch related or product sustaining or facility sustaining cost driver relate to a particular product line? And so you would come up with an estimate of the amount of the cost driver to be used in the production activities. And then you would essentially calculate the cost driver by dividing the estimated costs by the estimated cost driver for each of the cost pools. It sounds a little complicated. We'll be giving you an example of that. It's the math is relatively simple here, so just make sure you get this in your notes, and it'll be clearer to you as we move through the process. Once you do this, then you decide you assign the manufacturing overhead to the work in process during the period, and you make sure that the appropriate cost driver is applied. Then you actually record the manufacturing overhead as it is incurred, and then last but not least, you reconcile and close the manufacturing overhead account at the end of the period when you are preparing the financial statements. So we're gonna end it right here, guys. Before we get too late, so please make sure you have good notes on each of these particular slides, and we'll look forward to seeing you tomorrow.